Welcome back to If the Public Only Knew, the podcast where we rip off the Band-Aid of financial ignorance and expose the raw and sometimes ugly truth about the investing world. I'm your host, Gary Cinderbrand, and today we're diving headfirst into the murky waters of investor psychology. Buckle up, because we're about to explore why your brain might be your worst enemy when it comes to making smart investment decisions. When I was attending the University of Colorado at Boulder, trying to figure out what I wanted to do with my life, I was always interested in kind of how animals interacted with the environment. Had no idea what that would do long term, but I ended up with a degree in environmental biology and kind of majored in abnormal animal behavior. Little did I know how much good that would do me in my career as a 4 decades financial advisor at Merrill Lynch and UBS. So, advanced warning. Before you start throwing tomatoes at your radio, or whatever the hell you're listening to me on, let me clarify. I'm not saying that these mistakes make you dumb. Clearly, if you have money to invest, you've done something that's smart enough to be able to accumulate it. So even the most intelligent people are going to fall prey to sneaky little mental hand grenades where it feels right at the time, but when you look back, you just wish you could absolutely change it. Okay, so what are these biases that we're trying to get away from? Biases are things that can be created in a variety of different ways. Basically, they're mental shortcuts our brains take to simplify complex situations. Sounds helpful, right? Wrong, sorry. These shortcuts often lead to distorted thinking and irrational decisions, especially when it comes to money. Let's take a look at some of the usual suspects. First up, let's have confirmation bias. This bad boy makes you seek out information that confirms your existing beliefs, while conveniently ignoring anything that contradicts your brilliant ideas. It's like only reading glowing reviews of that questionable stock you just bought, while pretending those pesky negative reports don't exist. After all, what could those people possibly know? Also, the algorithms that power your newsfeed and seemingly everything else in our lives aren't going to feed you things they don't think you'll read. They'll feed you things all day long as long as you can give them a little bit of eyeball and maybe a click to one of their sponsors. So that's one of them, and I think that's a pretty big one, confirmation bias. Now, the next thing we have is loss aversion. This is amazing. I used to have these conversations very frequently with investors that were kind of self-guided, made a lot of their own decisions, which in most cases is sort of like self-administered dentistry. So portfolio of stocks would be selected. A client would pick, let's say, 10 stocks. And let's say 6 of them did pretty well. They all kind of went up, but 4 of them went down, and some of them went down pretty far. So what will happen is that they'll take the profits, happy to pay the tax, but the stocks they believed in, the other 4, none of which did exactly what they wanted to do. Basically, they don't want to sell them because they don't think they want to realize the loss. Think about that for a second. You're realizing that loss every moment of the day. It's no longer in your column of net worth. The question you really have to ask is this: would you establish a position in these same stocks at these prices? You know where you bought them before, but if you had all cash right now, would you buy these stocks right now at this price? And if the answer to that is no, then what the hell are you doing with them? Get rid of them. If the answer to that's yes, you'd still buy it, well, then it's time to average down. But loss aversion, you just can't sit there and make believe it's not happening. Closing your eyes and pretending there's not a monster in the closet doesn't mean there's not a monster in the closet. Usually there's not, but you can't make believe. You got to take a look. Now let's go into the next one. This is one of my favorites, herding bias. And that's not H-U-R-T-I-N-G. That's herding, like you're moving with the herd. You're going to do what the crowd does. If everyone says buy, you're going to buy. If everybody you know says sell, maybe you sell. In doing this, essentially what you're doing is following a crowd. Now, whether that crowd is in the middle of a move up or is heading for a financial cliff, you don't know because you're in the middle of it. You're just not there. Normally, by the time the public hears about a growing trend or a hot stock or some other great idea, the professionals have been in there and earned the vast majority of what's about to happen. Here's a good side note for you. One of the ways mutual funds can really juice their returns is they've got great tie-in with the new issue desks at all the major firms. So if an equity's coming out, a stock is coming out, and it's going to come out in kind of a pre-sale, it's going to be its final round that the company's going to get before the company sells shares to the public. Well, if Goldman Sachs is valued, let's say Facebook, at $50 a share on the IPO, Facebook's probably gone through multiple rounds of financing, dozens and dozens, I would guess. But that final round is given to Goldman Sachs' institutional buyers at a substantial discount as to where they're ultimately going to price it. So they may get 1 million shares of Facebook at $30. And that's kind of the final round, final valuation. A month or so later, it prices out at 50. opens at 120 and Goldman Sachs is sitting there with a bunch at 30 that they can allocate to mutual funds or any place else they choose. Every firm does this. Public can't do it. Doesn't work that way. So I don't mean to depress you, but if you're just moving with the crowd, it's going to be a problem sooner rather than later. What you need to do is educate yourself and have a firm goal that you're attached to. That goal needs to be a computed number that takes you from where you are, which we call point A, to where you want to be, which we'll call point B. Things happen in the middle. Markets open and close. Volatility occurs. Market rises and falls. Over time, it goes up more often than it goes down. But you have to have the mental discipline to stay focused on the outcome as opposed to what's happening near term. Best not even to look at it. Having a disciplined investment strategy means you had clear goals. You have a plan, it's updated regularly, and you're going to stick to it. That's a difficult thing to do as an individual. I made a very nice living for many, many years, helping people not make proper investment decisions. That part was pretty easy. It's just math. But having them work through the emotions of what those decisions would be, and in times of weakness where they felt that things were just never going to get better, I would provide perspective, guidance, and support, knowing they would, because it's what I do every single day. In times when the market seemed like it would never go down again, and clients wanted to put more money on the growth or volatility side than was prudent, especially as they approached retirement, I would counsel against it, often getting into arguments with my clients. But I would explain, we talked about this at the beginning of the relationship. I used to go through all of these biases and all of these behaviors and actually give clients a document that they would take home, and I would tell them where to dog-ear the pages, because at some point over the course of our relationship, we're going to be discussing it. There are a lot of traps when you start to think about investing just to kind of make money or beat the market or whatever the hell you're trying to do. Have a goal, update it regularly, do the math, and stay disciplined in what you do. Find a good advisor. If they can't explain how they do asset allocation and how asset allocation and return intersect with uncertainty and risk, move on to another advisor. This is Gary Cinderbrand. Thanks for listening.